During this video, we will discuss the purpose of financial forecasting, why financial forecasting is important, who uses this information, how to develop pro forma statements using the percentage of sales method, and the application of sustainable growth, discretionary financing to determine a firm's financing needs. It's important to remember that the primary objective of preparing financial plans is to prepare the future financing requirements in advance of when the financing will be needed. The purpose of financial forecasting. It helps decision makers understand how actions today can impact the firm's future performance. Financial forecasting starts with projection of the sales revenues and expenses, in other words, the operation of the firm. You start with the sales and operation to determine the financing needs throughout this period to fund its assets. So why start with the sales forecast? Well, the sales forecast allows you to spot potential issues while there's still time to avoid or mitigate them. It allows you to properly plan for seasonality demand. For instance, you're able to predict and plan for demand throughout the year, keeping appropriate levels of stock, hiring temporary staff, spacing projects. It helps business leaders make wiser business investments, whether or not to expand locations, invest in a new application, or hire additional staff. You start with sales to quickly identify and mitigate potential problems. Changes to, for instance, the sales compensation plan, changes to your marketing or sales lead process, competitor promotions, economic changes, new regulations, new laws. Additionally, it helps you improve your own sales process to understand how things work so you can identify ways to make them work better. In essence, it improves the company's quality control in terms of morale because you have better planning, better business decisions, better sales processes, and faster problem identification and mitigation. The sales forecast is the key ingredient in the firm's planning process. It reflects the past trend in sales that is expected to carry through the current and new year. Profit forecasting. This is the earnings change with changes in production or service costs, depreciation, policies, and taxes. It may be necessary for a company to conduct a thorough study and estimation on both economic and non-economic variables that affected sales volume, as well as costs to operate the business that affects profits in the future. Balance sheet forecasting, given the understanding of the sales growth and profit forecast, a financial manager can construct a pro forma balance sheet to understand how sources and uses of finances change in the company. Balance sheet forecasting helps management understand the future asset earning potential of the company. In general, growth requires an increase in assets in the form of additional working capital. Think more inventory, more receivables, as well as additional fixed assets, such as property, plant, and equipment. Of course, increasing assets requires increasing financing. As you remember from accounting, assets equal liabilities plus owner's equity. So increasing assets requires the firm to either borrow more money or increase equity from either retained earnings or issuing new stock. The question that forecasting answers is given expectations for future growth in sales, asset base, etc., how much additional financing will you need? While forecasting is not budgeting, um, as I said, forecasting is not budgeting. While budgeting quantifies the expected performance that a company wants to achieve in a future period, financial forecasting estimates the number of sales that will be achieved in the future to understand the future financial needs of the company. A budget is compared to actual results to understand why and how the company's performance differed from the expected results. We call this a variance analysis. The management team can take actions to adjust the budget based on the company's actual performance. A forecast can be used to take immediate action, such as changing the company's credit standards, inventory holdings, production levels, dividend policies, and so forth. So unlike budgeting, there is no variance analysis to compare the forecast with actual performance. Financial forecasting is a report illustrating whether the company is reaching its budget goals and showing where the company is heading in the future. So some of the forecasting tools are used is the percentage of sales method, the sustainable growth rate, SGR, and discretionary financing or additional financing or external financing. That's the DFN, AFN, and EFN. The percentage of sales method, rule number one, you should not be afraid to refine the estimates from this method if you have better information. So never fall in love with your data, as the data could change. You need to update your analysis. The percentage of sales method. Again, as I mentioned, you should not be afraid to refine the estimates from this method if you have better information. It involves estimating the level of expense, asset, or liability for a future period as a percentage of the sales forecast. The percentages can come from recent financial statements or from averages over past years, from the judgment of an analyst, or some combination of sources. Pro formas are forecasted financial statements. Financial forecasting requires a number of assumptions. Key assumptions include future sales levels, the relationship between sales and assets, and the firm's profitability. Because assumptions are used, forecasting is vulnerable to, as we say, garbage in, garbage out. That is, while an analyst is free to enter whatever assumptions into the forecast that he or she may desire, the end result will only be as accurate as the original assumptions employed. If the analyst does not make these assumptions carefully and accurately, the resulting financial forecast will be inaccurate. Spontaneous accounts are those that vary naturally with sales. That is, as sales increase, some accounts, such as accounts receivable, inventory, accounts payable, automatically increase as well. Spontaneous assets and liabilities are normally automatically accumulated as the result of a firm's day-to-day business activities. For instance, assume that the company produces and sells cars. If the company anticipates sales growth in cars, it orders raw materials to manufacture more cars and holds more finished cars to increase its inventory and meet the sales growth. When raw materials are purchased, the accounts payable of the company increase as well. The sales growth also increases both the cash and accounts receivable accounts. The projected growth in spontaneous accounts is an important measure for companies to evaluate how much extra funding is needed to meet that growth. With spontaneous financing, I always think of an ice cream parlor. Okay, so if you're an ice cream parlor and you're selling more ice cream cones, well, you're going to need more ice cream to sell. That's inventory. You're going to need more cups, spoons, cones, toppings, in my case, napkins. Either way, you're going to need inventory to sell. Well, how are you paying for that inventory? Perhaps you're going to pay it on account, thus increasing accounts payable. It's important to remember, though, with spontaneous financing, that pendulum swings both ways. We talk about spontaneous accounts in that when activity increases, sales increase, all these other accounts increase. But as I said, that pendulum could also go the other way. So when sales decrease, you have less cash, less accounts receivable, less payables, less net income, and so forth. Discretionary accounts. For instance, if a car company expects a growth in sales, can we assume that the company's bank loans or bond increases in proportion to the sales growth? The answer is no. If extra funds are needed, management tries to find a way to manage additional financing needs without getting new loans or issuing new stock if possible. These accounts do not increase automatically with sales, but are left to the discretion of management. The percentage of sales method consists of 7 steps. You want to be able to project your sales, revenue, and expenses, again, the operations. You want to be able to forecast the change in spontaneous balance sheet accounts. Deal with discretionary accounts, those accounts that do not fluctuate with the level of sales. Estimate fixed asset account, calculate retained earnings, and determine total financing needs for projected total assets. You want to then calculate DFN. It's important to remember that the percentage of sales method can be considered a shortcut, less exact, and easier method of determining financing needs. In other words, it's a quick and easy approach. To determine the amount in which sales are expected to increase, we first need to identify the accounts closely related to sales. Again, our spontaneous accounts. We're going to use cash, accounts receivable, inventory, fixed assets, although it is could be a lumpy asset, which we'll talk about in a little bit, accounts payable, sales, cost of goods sold, and net income. With the percentage of sales method, assume that we have a value for each of these accounts. And what you're going to do with each of these accounts is take the balance and divide that by your assumed or projected sales account. So in this case, we would take cash, $500, divided by 2,000. Accounts receivable, take the 6,000 divided by 2,000. So you come up with percentages, okay? These now change your pro forma statements. In other words, you're now able to build something. You can take your cash account that was $500 and say, okay, if my sales goes to 2,000, I'm going to have an increase in cash by 25%. So in essence, what you're doing is you're taking the 500 divided by 2,000 and you're taking, in other words, 500 times 125%. You have to take the increment and then add it back to the original amount. And we do that for each of these accounts. So when we take the 500 divided by 2,000, we come up with 25%. Well, 25% of 500 is not 625. 125% of 500 is 625. And we do that for each of those accounts to come up with the new value for your balance sheet and income statement accounts. The percent pro forma income statement. That is basically saying if sales are going to grow 10% next year, our costs, expenses, we estimate, not including depreciation, will also increase by 10% next year. This assumption is based on the observation that when a firm has a sales increase, the firm needs to purchase more raw materials and needs more labor hours, etc. So if you wanted to look at a quick question, one essential component for a financial manager is A, the ability to plan ahead and make necessary adjustments before actual events occur. B, the ability to accurately determine the firm's earnings. C, ability to prepare the firm's financial statements. Or D, ability to manage the firm's accounts receivables. The answer is A, ability to plan and make necessary adjustments before actual events occur. The most comprehensive approach to financial forecasting is A, through the use of market analysts to assess the value of the firm. B, using a short-term lens. C, using a long-term lens. Or D, using pro forma financial statements. And it's D, using pro forma financial statements. Construction of a pro forma income statement is based on A, the prior year's income statement, B, sales projections and the production plan, C, the cash budget, D, the cash budget and prior year's income statement. And it's B, sales projections and the production plan. Which of the following is not a step in the development of a pro forma statement? A, establish a sales projection. B, determine a production schedule and associated expenses to determine gross profit. C, determine the cash receipts. D, determine profit by completing the actual pro forma statement. And the answer is C, to determine the cash receipts. In preparing a pro forma balance sheet, all of the following will normally remain unchanged from the prior period except A, accounts receivable, B, marketable securities, C, long-term debt, D, common stock. The answer is accounts receivable. Think back to the ice cream parlor example or the car dealership example. So what is a pro forma statement? So these are financial reports. They're financial statements based on hypothetical scenarios, guesstimates, to illustrate the impact of projections. It's important to remember that depreciation is usually based on the asset base, so it's more reasonable to forecast depreciation as a percent of net and plant equipment. not necessarily sales. The key ingredient, remember, is going to be the sales forecast driving the income statement. And if you think about the income statement, it's your operational report of the firm. It shows you the money coming in, sales, and the money going out, operations. For balance sheets, accounts such as cash, accounts receivable, inventory, net plant and equipment, accounts payable, accruals are usually assumed to increase, and again, that pendulum swings both ways or decrease proportionately with sales. There may also be economies of scale in inventories. As a result, inventories may grow less rapidly than sales. There may also be unused capacity in the exiting fixed assets. Thus, there may be no fixed assets needed when sales increase moderately. So if we look at the Howard Corporation balance sheet and we assume that the sales is $200,000 and we take the account similar to what we looked at a few minutes ago, cash, accounts receivable, and so forth, we take these amounts, as you remember, we divide it by our projected sales, and we then come up with our percentages. So when we take our percentages, sales of 5,000 divided by 200,000 and so forth, we then are able to create a balance sheet for this Howard Corporation based on the assumed sales level of 200,000. So now I'm able to take my percentages and say, okay, cash is 2.5% of 200,000, so my cash is 5,000. Accounts receivable is 20% of 200,000, so my accounts receivable account should have 40,000. I do the same with inventory, my current assets, my equipment, and I have my asset base, my pro forma built. I then do the same thing with the liabilities. I say, okay, accounts payable is 20% of my $200,000 projected assumed sales. 20% of 200,000 is 40,000. I do the same with my accrued expenses. Now, if you look at notes payable, common stock, retained earnings, those don't change with sales. So those would go in as is, unchanged. Again, go back to the ice cream cone example. If you sold one ice cream cone or 1,000,000, your rent hasn't changed. That fixed expense is the same. Same thing with your notes payable. Okay? It's a contracted amount. That's not going to change based on sales. When you're looking at sales capacity, it basically says, okay, how much money does a firm have to invest in the fixed assets? Specifically, if their sales exceeds their sales capacity. Assume that a firm must invest in a fixed asset by $5 million if it exceeds sales capacity. If the current production level is 80%, in other words, the firm is only producing 80% of what it could produce, and the current sales are $240 million, then the sales capacity is $300 million. 300 million, that is, the firm can grow by $60 million or by 25%. 25% is just taking the $60 million, the difference between total capacity minus 80% capacity of 240 million, and that leaves us a balance of $60 million. If you take that difference of $60 million, divide that by current capacity of 240, that gives you 25%. Well, if 10% growth is projected next year, no additional financing investment in fixed assets may be required. The firm has sufficient capacity to handle the increased production without buying any new fixed assets. On the other hand, if the company is expecting 30% sales growth this coming year due to many positive shocks in the market, it will exceed the sales capacity by $12 million. 30% of 240 billion is 72 million, and thus it will have to invest $5 million in assets. Okay, so at 30% growth, the firm will exceed the sales capacity by $12 million, which is 30% of $240 million, which equals 72 million. 72 million at 30% growth minus the 60 of 100% capacity leaves us a balance that we'd have to adhere to, that we'd have to fund of 12 million. So in order to come up with that capacity difference, this firm will have to invest in new equipment. There's limitations to this percentage of sales method. The method provides reasonable estimates of financing requirements only when an asset requirements and financing sources can be accurately forecast as a constant percent of sales. However, this relationship may not always hold true. Economies of scale are sometimes realized from investing in certain types of assets. Some assets are lumpy assets or assets that must be purchased in large, non-divisible components. Go back to the ice cream parlor for a second. Imagine your ice cream parlor produces 50 cones a day. Has the soft serve machine, it only does 50 cones a day. And you're expecting it to grow to 75 cones a day. Perhaps this new ice cream machine cost $1 million. I know a lot, but say it cost $1 million. Well, is that 25 cones per day worth that expense of $1 million? These are what we need to now investigate. If so, how do we finance it? What can the firm do? And we now look at different techniques on how to adhere and how to address lumpy assets. Again, those capital investments. And we do that with EFN, DFN, and so forth. Again, a quick reminder, spontaneous accounts. These are the accounts that increase or decrease with sales. Cash, accounts receivable, inventory, and so forth. It's your balance sheet and income statement accounts. Additional financing is called the discretionary financing needed, DFN, also known as the external financing needed, EFN, or additional financing needed, AFN. Estimating DFN is the primary objective of the forecasting process. This amount can be financed by an increase in notes payable, long-term bonds, which is debt, preferred stock, common stock, or any combination of them all. There are 4 steps in calculating DFN. We want to first convert each asset and liability account that varies directly with the firm's sales to a percentage of the current year's sales. So if we have current assets of $2 million and we have our assumed sales at $10 million, that equals 0.2 or 20%. Again, spontaneous accounts are those accounts that are directly impacted by increases and decreases in sales. We then want to be able to predict our current assets. So Project the level of each asset and liability account in the balance sheet using its percentage of sales multiplied by projected sales, or by leaving the account balance unchanged when the account does not vary with the level of sales. So if we have a projected current asset, and we know that that's going to equal our projected sales times current assets divided by sales, we know that our assets are 12 million times 20% equals 2.4 million. Predicting additional retained earnings. Project the addition to retained earnings available to help finance the firm's operation. This amount equals the projected net income for the period less planned common stock dividends. So we know that the projected addition to retained earnings is going to equal our projected sales times our net income divided by sales times 1 minus cash dividends divided by net income. And our result would be 12 million times 0.05 times 1 minus 0.05, and that equals 300,000. And we'll see how this works in the actual financial performance. Predicting DFN. You want to project the firm's discretionary financing as the projected level of total assets less projected liabilities less owner's equity. So all we're doing to come up with DFN is we're going to come up and determine a projected level of assets minus the projected level of total liabilities minus the projected level of owner's equity. In this case, 7.2 minus 4.9 minus 1.8 equals $500,000. So we need additional financing. If this number was zero or negative, it would mean that no additional financing is needed. Additional financing, again, is called the discretionary financing, EFN, external financing, or additional financing. It's an estimate, okay? And again, the primary objective of the forecasting process. Okay. It includes the firm's needs for financing beyond the funds provided internally through the retention of earnings. Analyzing the effects of profitability and dividend policy on the firm's DFN, discretionary financing needs. Got to remember that the dividend payout ratios and net profit margin vary. As a result, financing needed, discretionary financing, also changes significantly. When you're looking at the internal growth rate, you can consider this as the maximum growth rate that can be achieved with no external financing of any kind, neither new debt nor new equity. Only internally retained earnings are used to fund growth. What we're doing is we're taking the ROA times your dividend payout divided by 1 minus ROA times B, where ROA equals net income divided by total assets, and B is that retention ratio, which equals addition to retained earnings divided by net income. The sustainable growth rate, SGR, this is the maximum growth rate a firm can achieve with no external financing, no new shares, while it maintains a constant debt ratio. This is a popular target for growth amongst many firms, And this growth concept is used at most Fortune 500 companies. Firms do not like to issue new shares because when they announce new issues, the price of their old shares fall. For instance, if you have a company and it had 100 shares of stock and each share was $1, and all of a sudden the valuation now is $100, $1 times 100 shares outstanding, and the company issues another 100 shares. Well, the valuation of the firm hasn't changed. So now each share that you own is now, instead of being worth $1, is now worth 50 cents per share. It's also important to remember that the higher the retention ratio, the higher the SGR. The higher the return on equity, the ROE, the higher the SGR. From the DuPont equation, which is your profit margin times your total asset turnover times your leverage multiplier, or sometimes called equity multiplier, we know that ROE, because DuPont equals ROE, is positively related to profit margin, total asset turnover, and the equity multiplier. Thus, SGR is positively related to the four variables: retention ratio, in addition to the components of DuPont. So SGR is going to equal your ROE times B, retention ratio, divided by 1 minus ROE times B, again, retention ratio, and SGR will always be higher than IGR. There are some implications of SGR. If a firm wants to pursue a growth rate that is higher than its sustainable growth rate, the firm must do one of the following actions. It must either retain more earnings within the firm, so pay less dividends, although your shareholders might not be happy about that. It might need to increase its profit margin. So by increasing profit margin, you're looking at either lowering costs or increasing profit or prices, or a combination. You need to increase your total asset turnover. Again, these are components of your DuPont. But if I wanted to increase total asset turnover, perhaps I need to make sure that the quality that's being produced is up to par. I have to make sure there's less defects. I have to make sure my marketing team is doing their job, or that there's promotions for my competitors. I understand the ramifications. In other words, I need to understand what's driving demand for my product being sold. I may need to increase financial leverage, borrow more. That's that equity multiplier, that leverage multiplier. Or I can sell new shares. Depending on the size of a firm's DFN, it can be challenging to obtain sufficient capital to support sales growth. In order to reduce the DFN, you can take many actions to either reduce projected assets or increase projected financing. So assuming the firm does not want to issue new equity, there are basically four methods of decreasing DFN. So increasing prices will slow down the growth rate and reduce DFN in two ways. Higher prices will increase your net margin, leading to higher net income and more cash retained within the firm. And then second, lower sales will decrease forecasted assets in the pro forma balance sheet, thus reducing future financing needs. Imagine that ice cream parlor again. All of a sudden, if I increase the price of the ice cream, I increase my profit margin. I will sell less ice cream, although I will maintain profits, but I won't have to buy that $1 million machine so I'm able to push back, lower my SGR. Ways to reduce discretionary. You got to remember, while it seems counterintuitive for an entrepreneur or CEO to deliberately decrease sales, slowing growth by increasing prices may actually serve to increase total firm value and profitability. One of the big drivers of DFN is the expansion of fixed assets. Hence, when financing constraints start to bind, one of the first variables managers look at is fixed assets. Additionally, they look at outsourcing production of some components. Effectively, these types of questions fit back into SGR equation by examining the total asset turnover ratio. So again, SGR and ROE using DuPont, very related. It's possible, if it's possible to squeeze more dollars in sales out of each dollar in assets, the DFN will be reduced. Again, if it is possible to squeeze more dollars in sales out of each dollar in assets, the DFN will be reduced. If the company were to lower its annual dividend payment, thereby increasing its retention ratio, more earnings would remain within the firm and the DFN would decrease. The problem with the scenario is that stockholders normally do not react well to reduced dividends. Even when the CEO is able to explain to the shareholders the reason for the change and the opportunity it affords them, or the firm, I should say, shareholders will not still likely have a negative reaction to a lower dividend payment. The larger the company's net margin ratio, the higher the level of earnings per dollar of sales. So higher earnings lead to more cash retained within the company, which in turn decreases the DFN. So besides increasing the product sales price, the firm could also increase the net margin by cutting costs. Increased sales volumes will help the process as firms can take advantage of economies of scale and get better prices from their suppliers. There also are usually a number of managed expenses within the firm, such as advertising costs and so forth, that can be managed in order to increase net margin in a given year. When you're dealing with the limitations of the sustainable growth rate, consider a business that competes in a market where consumers are on a tight budget due to lower income. These consumers are traditionally more conservative with their spending habits. The business may stay competitive in this market by cutting prices and potentially decreasing growth. In addition, the business might also invest money to develop new products that will appeal to existing customers. This would help the business maintain its customer base and gain market share, but it would also increase the cost for the business and could cut into the business's ability to grow and achieve its SGR, its sustainable growth rate. A company's poor financial forecasting and business planning can also diminish its ability to achieve sustainable growth in the long run. Misunderstanding the company's growth strategy or misestimating its growth capability may lead to an incorrect calculation of its optimal SGR. When a company makes a poor long-term plan, it may be the case that the company achieves a high degree of growth in the short run, but that this growth is not sustainable in the long run. It will not last. I want you to think of these companies that weren't doing so well, and to turn themselves around, they started last year producing masks. face masks for COVID. Well, now that, God willing, COVID is nearing its transition, so to speak, what are these companies going to do in the long term? Their short term, they got the bump up in activity, production, sales, but long term, what's their approach? So, in the long run, a business needs to reinvest in itself, considering new products or increasing production capacity, which requires the company to purchase fixed assets such as property, plant, and equipment. As a result, the company will require additional financing to fund its long-term growth through these investments. Some companies in more capital-intensive industries need a combination of debt and equity financing in order to keep operating because of the high cost of equipment. So, while the SGR is often used as a goal for a firm, simply calculating the SGR and striving to achieve and maintain this rate is not necessarily the optimal way to use it. Each company needs to consider many different factors, both economic and non-economic, in its use of the sustainable growth rate.